Let's talk asset bubbles, okay? What is an asset bubble? What causes them? What causes them to pop? And how can you profit from it, okay? Because we are about making that money in 2020. It's been ghetto enough. We don't need to be losing cash, okay? So keep lots for all that and more. It's Crystal with the Cash Compass. All right, so welcome back. I am here to teach you all the things that you should have learned in school about money, but for whatever reason, they forgot to mention it. Please be sure to subscribe because we talk about everything from personal finance to investing into the economy. Let's get into it. So I'm sure we all know, but I don't like making assumptions, okay? So an asset bubble is basically when an asset, that could be real estate, that can be stocks, it can be precious metals, when it gets inflated to an astronomical amount with no justification, okay? Kind of like how your mom would get an astronomical attitude and there was no reason behind it. Yeah, just like that. And while we could typically look at it from a macro level, like stocks in general or real estate in general, it can also be on a micro level too, like an individual stock, Tesla, no shade to Tesla though, a specific place like maybe California or New York real estate and things like that. And like all bubbles, it must pop. It's unsustainable. There's only so much air you can pump into it before it falls to the ground. I like to look at asset bubbles from a fear to greed scale, where I actually think fear weighs a little bit heavier. So greed will help it climb up. But then once people start getting fear in them, they get a little bit weak. And then that's when you can see dramatic fluctuations, kind of like what happened in March with the stock market. Once one person gets scared, everybody starts getting scared. And then you just see a 37% drop within a matter of weeks. Okay, that is an example of something popping. And I want to show you guys this chart because it does a great job of actually showing the whole cycle of a bubble. And you can see here we start off with the stealth phase, and that's pretty much when the smart money gets in and they're like, okay, the fundamentals are strong, the company looks promising, we're gonna get in there. So then you'll have that slight takeoff, right? Now we're going from the stealth phase, which is the smart money who follows the fundamentals, into the institutional investors. And these are things like your pensions and your hedge funds where, they're kind of getting into that too. The hype is kind of building up, but not quite crazy yet. Then we get into media attention, and we all know people trust anything they see on television. It's almost sickening how much people believe things that they hear, but that is a completely different video. But the point is, it's starting to get media coverage. It's starting to get much more hype. You're seeing it maybe on your social medias too. It's just blowing up, okay? Then things just get back crazy. And then you see random people at the gas station buying it. You hear your teenage cousin talking about he's gonna buy the stocks. And that's when you're like, yeah, it's time to go. We need to go ahead and get up out of this, okay? So as you see, you'll have that kind of like, oh, it's okay, everybody's buying it. And then you see a little bit of a dip and people start to get scared, but then they're like, buy the dip, buy the dip. So then it kind of ratchets it back up just a touch and then it goes flying down, okay? And that's where you'll see complete fear, people selling off like a madman. And then we start that cycle all over again when the smart money's like, all right, the hype is over, the fundamentals are still in place, let's get back in. This can be caused by a couple of different factors. Like I mentioned before, hype can be one of them, where you're like, oh, the Tesla stock is going up, you're gonna get some great gains and people don't wanna miss out, right? So they're gonna go ahead and buy that. It could also be something like information, like, oh, this company came up with a vaccine and it's looking promising, right? So that can kind of get people to pour in and create a bubble as well. Scarcity, people like, oh my gosh, like there's only a certain amount of Bitcoin and it's gonna go through the moon, so get it while you can because you can't mine more Bitcoin. But in order to actually have those other factors, we need one of two things or even both, and that'll be leverage and liquidity, okay? Leverage is basically your ability to borrow, right? So when there's cheap money, people can actually get loans for a better price so they can actually increase their yield, okay? So for example, if I can get a personal loan for 3% and I can kind of shove it into the stock market and make 10%, well, that's 7%. That's mine. So if money is cheap, people are going to be able to borrow more and try to go ahead and gamble with that money to create a bigger return. Also liquidity. That'll be the Federal Reserve and our U.S. Treasury just handing out loans and pumping in money into the system just to get people to kind of spend more. When people have more money, and when I say people, I don't mean those who got the $1,200 check, because let's be real, that's gone. But people like the corporations, the higher ups, the big people, the big shots, when they're getting that extra liquidity, they can also take more bets because they have more money to work with. So it can also actually drive the prices up. And that's what we're seeing right now, is specifically in the stock market, where we had that dip in March and then all this funny money, the fiscal policies, the monetary policies, all those things have gotten in there and shot this market back up. Like I've been saying, it's going to keep on going up because they're just kind of pumping all this extra money in there. And if there's going to be more money being created, then it has to go somewhere. There is no money waiting room. It's going to go either in people's savings accounts, in the stock market, in real estate. It's going somewhere. And let's be real, this works until it doesn't, right? I mean, I'm not going to get mad at you because you were able to get in there, maybe buy a house at $200,000 and I was worth $400,000. Do your thing, right? If you got your stocks and it's looking juicy, it is okay until it's not, okay? As long as you can get in and get out, then the asset bubble is working well for you. But it's kind of just being able to identify when you need to move in and out of these markets and actually be actively looking at the economy, looking at the companies that you're invested in, looking at the real estate market. I mean, really getting in there and seeing the market trends. That same chart that I showed you. Where are we in that trend? Is it time to pull out? And I'm not mad at that as a strategy. Obviously, people who are trading the market, they're always looking for these kind of dips and valleys so they can get in and get out. The problem is if you are a long-term investor, which I think the average person is because a lot of them are not traders, you're doing yourself a great disservice by just focusing on the price only. You must focus on value, and they are two different things. For example, Tesla was having a crazy boom at one point, right? And they were just kind of shooting through the roof. If you were only price focused, well, then you would be very disappointed when the price had shot down because Elon Musk himself was like, it's a little bit too high for me, dog, right? But if you are fundamentals focused and you're like, this is a solid company, and I'm not saying I agree or disagree with this, by the way, but if you are fundamentals focused and you're like, they have a good balance sheet, they have a good income statement, their business model makes sense to me, I believe in this company, then you won't be swayed so heavily by, price fluctuations. When you are focused only on price, it allows you to be a little bit more emotional, okay? And nothing's wrong with emotions, okay? Give me a hug. But to my point, that will allow you to make irrational decisions. You should always focus on the fundamentals. If you guys want a video of me kind of discussing like the fundamentals, like looking at someone's balance sheet, looking at someone's income statement and things like that, let me know in the comments, okay? Talk to me. So what about our economy, okay? Almost everything is in a bubble. Honestly, the only thing that is not in a bubble right now are gold and silver. They are heavily suppressed. They will reach a bubble. I know I talk about precious metals a lot, but there will be an opportunity and a time to sell if you want to maximize your gains. Right now, in my opinion, of course, I don't believe gold and silver are in bubbles. But I definitely think the real estate market is. There's certain factors that you look at, like, for example, the price to income ratio, which I will get into in a moment. But there's certain factors you look at within stocks, within real estate, and within other asset classes to let you know that things are getting out of control. The stock market, like I mentioned before, definitely is in a bubble. You see it was going towards correction, right, in March, but then the powers that be stepped in and now it is still going through the roof. It's definitely in a bubble, but this is a manipulated bubble. So it's almost hard to kind of focus on fundamentals right now because honestly, these companies can be making no money, okay? In fact, that Nikola company has not made a single dollar in revenue yet. And for some reason, they have a market cap larger than Ford. So when you're seeing things like that, it's almost clear as day that we are in an absolute bubble and people have gone hysteric. What about real estate, right? Let's talk about that. On average, the price to income ratio, which is basically how much income you have relative to the price of your home, should be around 3. So that would mean that in most areas, right, if you make 80,000, your house would be 240,000, and that would make sense because that's the historic norm. That ratio is now over 4.5%, and it's just marching its way on to 5, and that is not sustainable. How long can you keep prices at these astronomical levels when people are not making that much money to actually afford these homes? There has to be a correction at some point, but who knows when? And the real estate market moves much slower than the stock market, right? So like in 2008, for example, it took the real estate market 4 years to actually fully bottom before it started climbing back up. So real estate moves a little bit slower. Stocks, it can be, overnight. Things just dramatically change. And you have to kind of know that when you're moving into these assets. So let's make money from this, okay? How can we make money from these asset bubbles? Like I said earlier, these things always move in a trend, whether it's manipulated or not, right? Because when they pull the rug from under the market, then that's when the free market actually comes back into play and things will reach their fair market value, okay? So look at that chart, study it, and look at the different assets you're investing in. Can you see similarities? Can you see those hills and those valleys? I'm sure you can. So just get really well acclimated with your investments, get really well versed with your wherever you're at, whether it's in real estate, get comfortable with your location, get comfortable with the industry that you're investing in, with the stock market. get comfortable with whatever you're putting your money into, okay? And that's not just with assets, in your real life too, okay? Stick to the fundamentals. When you're sticking to the fundamentals, you almost can't lose, right? Because if you have faith in a company, if you've done your due diligence, they might have a small setback, but that'll just set them up for a greater comeback, okay? So you don't want to put so much emotion into it. You want to actually follow that up with some logic and actually have the logic overpower the emotion, because then that'll allow you to make better decisions. A lot of people hear the term buy low, sell high. I think we all know that, but a lot of people instead choose to buy high and sell higher. That does work, but not all the time. So you really want to make sure you understand what the value is, not the price. When I say buy low, sell high, I mean buy low relative to its value. So wow, it really should be worth $50, but it's only $2. That's value versus just a price, as in, oh, it's $50, but maybe it can go to $100. No, that's not fundamentals focused. You will get messed up, okay? And I don't want that to happen to you. And personally, I feel if that's too much for you, then just back on out, okay? It's okay to save your money. It's okay to kind of see what is going on right now. I think if you're making a decision that you're comfortable with, then it doesn't really matter which way it goes, right? Because at least you know it was deep rooted in your choices and your research, and you should stand by that. And that's it. In this economy, it's really hard to tell what's going to go up and what's going to go down, because like I said a little bit too many times, everything is manipulated, okay? So just do your due diligence, be focused, and if you can't do that, then just step away. But that will do it. If you like this video, then please like this video and share with your friends. And if you made it this far, just subscribe, okay? And I have some videos for you to check out if you're not doing anything, okay? So go ahead and binge watch me. And until next time, keep your money up.